This presentation has been designed to provide bank employees with an overview of the basic information about FDIC deposit insurance so they may assist depositors in calculating deposit insurance coverage. As a quick overview of what we will cover, today's presentation is divided into 4 parts, as described on this slide. Part 1, General Principles. Since its founding in 1933, the FDIC has protected depositors against the loss of their insured funds in the event of a failure of an FDIC-insured bank. As a result, in the long history of the FDIC, no depositor has ever lost a single penny of FDIC-insured funds. In addition to the Deposit Insurance Fund, the FDIC is backed by the full faith and credit of the United States government. Many of you may be familiar with the rules on the next few slides, but I want to take just a few minutes to quickly review some of the basics about FDIC deposit insurance coverage for anyone who may be new to the subject of deposit insurance. So, how are depositors insured by the FDIC? At each bank, depositors are insured for up to at least $250,000, which is the current standard amount of FDIC deposit insurance coverage. This amount is described in the FDIC regulations as the Standard Maximum Deposit Insurance Amount, or using the abbreviation SMDIA. The current SMDIA was permanently raised to $250,000 effective July 22, 2010, as provided for under the Dodd-Frank Wall Street Reform and Consumer Protection Act. Please remember the increase to $250,000 is permanent. Deposit insurance coverage includes principal and accrued interest up through the date of failure of the bank. An important point to remember is that the FDIC only insures funds that qualify as a deposit. The issue of what is or is not insured is one of the most common questions that depositors ask the FDIC. The chart on the left shows examples or types of deposits which are insured by the FDIC, including checking accounts, money market deposit accounts, savings accounts, NOW accounts, and certificates of deposit. The chart on the right includes examples of products that may be purchased from a bank but are not insured by the FDIC. Another common question depositors ask is, does the FDIC deposit insurance coverage include the accrued interest on the principal of a deposit? Well, as the example here shows, the answer is yes, but only to the extent that the interest does not exceed the insurance amount. As you can see in this example, $3,000 of interest has been earned. However, since $250,000 is the maximum amount that can be insured in Jane Smith's name alone, there is $1,000 of earned interest, which exceeds the insurance limit. Therefore, Jane Smith is uninsured in this example for $1,000. The FDIC deposit insurance coverage is provided per depositor, per ownership category, per bank. On the next few slides, we will explore each of these 3 areas. Let's discuss the first point, which addresses the issue of who is insured by the FDIC. Keep in mind that FDIC deposit insurance coverage is based on the owner or ownership of the deposit. Deposit accounts owned by different depositors are separately insured. So, who does the FDIC consider as a possible owner or a depositor? A depositor is the owner of the funds held in a deposit account and can include a natural person, a business organization, or a government entity. In order to qualify for deposit insurance coverage, a natural person does not have to be either a citizen or resident of the United States. Deposit insurance coverage is calculated per ownership category. A depositor who holds funds in different ownership categories at the same bank receives separate coverage for those funds. A depositor's funds held in the same ownership capacity at the same bank are added together in order to determine coverage. FDIC deposit insurance coverage is provided on a per-bank basis. The FDIC receives a lot of questions about exactly how deposit insurance coverage is calculated at a specific FDIC-insured bank. For example, depositors ask, am I separately insured if I deposit funds in different branches of the same bank? Or am I separately insured if I deposit funds in the branch offices of the same bank, but the branch offices are located in different states? The easy way to remember the rule is that all deposits in the same ownership capacity that a depositor places in a bank with the same FDIC charter number are added together. If the charter numbers are different, then the deposits are separately insured because FDIC deposit insurance coverage is separate for each FDIC-insured bank. Since separate branches of a bank share the same charter number, there is no separate insurance coverage. As we explained to depositors, FDIC deposit insurance coverage is exactly the same at each and every FDIC-insured bank, regardless of the size or the location of the bank. For the next few slides, we will discuss scenarios which will impact deposit insurance, including coverage when an account owner dies and when banks merge. Let's begin with how deposit insurance is impacted upon the death of an account owner. In situations where the owner of a deposit was a living person, but who has died since opening the deposit account, the death of an account owner may in some cases reduce the amount of deposit insurance coverage. This issue is common when funds are owned by two or more people under the joint account category and one of the owners dies. If the owner of a deposit account dies, the FDIC provides a 6-month grace period, which allows the account to continue to be insured as if the account owner was still alive. After the expiration of the 6-month grace period, the account continues to be eligible for deposit insurance, but the amount of coverage will need to be reviewed to consider whether the ownership of the funds, as well as the deposit ownership category that would be applied, have changed. Let's discuss deposit insurance coverage when banks merge. Please note that there is a difference in the rules which apply when two banks merge as compared to when a bank fails and the deposits are acquired by another FDIC-insured bank. So, what is the insurance coverage when a depositor has accounts in two banks that merge? Well, when two banks merge, the accounts are insured as if the banks were still separate legal entities for at least 6 months. There is a special exception for time deposits, such as certificates of deposits. Time deposits that were issued by the former bank are insured for the greater of either 6 months or the first maturity date of the time deposit. For detailed explanations of deposit insurance rules when banks merge, please attend one of the FDIC's 2016 Advanced Topics in Deposit Insurance Coverage seminars. The FDIC receives questions every day from depositors asking, how long will we have to wait to get our money if my bank fails? While the federal statute simply requires that the FDIC must make deposit insurance payments, and the exact words under the statute are, as soon as possible, it is important for bank employees to be aware that the FDIC is committed to make payments of deposit insurance in most situations as quickly as 1 or 2 business days after a bank fails. If the funds were placed by a deposit broker, it may take a bit longer to complete these payments, since the broker must first provide documentation to the FDIC indicating the owner of the funds and each owner's interest in the deposit. Once the insurance determination is complete, the FDIC does pay 100 cents on the dollar for all insured deposits. If a depositor has uninsured funds, typically they will recover a portion of their uninsured funds as the FDIC liquidates the failed bank assets. And as a final note, please be aware and also wary of anyone attempting to suggest that the FDIC takes 10 years, 30 years, or even 99 years to pay insured deposits. This is false and has no basis in fact. When an FDIC-insured bank fails, the FDIC relies on the deposit account records located at the bank to determine the ownership of the deposit funds and the amount of deposit insurance coverage. Listed on slide 15 are examples of bank records the FDIC may use in determining deposit insurance coverage. Part 2, Introduction to Ownership Categories. Here's where we begin to answer the questions that probably everyone listening today is repeatedly asked by depositors. First, how much can I be insured for by the FDIC? And second, what are the different ways depositors can be insured at an FDIC-insured bank? Now, if you're a bank employee responsible for opening new accounts, the FDIC recommends asking and answering the following questions. First, who owns the funds? Second, what ownership category is the depositor eligible to use or attempting to use? And question number 3, does the depositor meet the requirements of that category? Perhaps the single most important question to answer in calculating FDIC deposit insurance coverage is, who owns the funds? The answer to this question is critical because both the amount and the method for calculating FDIC deposit insurance coverage is based on the ownership of the deposit funds. As we noted previously, an owner or a depositor can be a person, a business organization, or a government entity. Establishing the ownership of the deposit funds is essential prior to determining which ownership category the depositor may be eligible to use. Once we figure out the answer to the question, who owns the funds, we can now ask our second question. What ownership category is the depositor eligible to use or attempting to use? So, what is an ownership category and why is this important? Well, let me explain it like this. A category is a unique basis of ownership defined by either an FDIC regulation or a federal statute that provides for separate FDIC deposit insurance coverage. In other words, think of a category as a set of rules. If a depositor can meet the rules for a specific deposit insurance ownership category, then their deposits will be entitled to the amount of deposit insurance coverage provided for under that category. In this seminar, we will discuss the 9 most common categories of deposit insurance coverage. Out of the 9 categories available, individuals can qualify for separate coverage under up to 6 different deposit insurance categories. Understanding the rules for each category is critical, since some of the categories allow for deposit insurance coverage in excess of $250,000, provided the specific requirements for that category are met. Let's say we've determined our owner is an individual. Then we have to determine which of the 6 categories available to depositors would the depositor like to use. Based on the category or categories they select, this raises the third question to explore. Does the depositor meet the requirements for the deposit insurance category they would like to use? In other words, just because an individual depositor would like to have deposit insurance coverage under each of the 6 categories available to individuals, it does not mean they can necessarily meet the requirements under each of the 6 categories. If a depositor can meet the rules of a particular category, then their deposits will be entitled to coverage up to the SMDIA. As you can see here, we have split the 9 deposit insurance ownership categories I mentioned into different groups. For the purpose of this presentation, I will be discussing the 9 categories using both a descriptive name as well as assigning a number to each category. The assignment of the category numbers is for this presentation only, so you won't find the category numbers mentioned in the FDIC regulations. To begin, on the left of our slide, you will see that an individual or individuals can potentially qualify to have deposits in 6 different ownership categories, including Category 1, single accounts, Category 2, joint accounts, Category 3, revocable trust accounts, Category 4, irrevocable trust accounts, Category 5, certain retirement accounts, and Category 6, employee benefit plan accounts. On the right side of our slide, we have Category 7, business organizations, which include corporations, partnerships, and unincorporated associations. Next, we have Category 8, government accounts, which covers deposits owned by a government entity or a public unit. And finally, we have Category 9, which exclusively covers mortgage servicing accounts that include the collected principal and interest payments from the borrower or mortgagor of a bank loan. To assist depositors, it is important to learn the specific requirements for each of these 9 categories. For today's presentation, I will be discussing in detail the 6 categories available to individual depositors, and I will also mention the basic requirements for the other 3 deposit insurance categories. Part 3, Review of Ownership Category Requirements. To help introduce the concept of ownership categories, we have created a hypothetical signature card to illustrate how the information collected at the time an account is opened is linked to the different FDIC ownership categories. Please note, we are not suggesting your bank use the format provided on the next few slides in establishing your own bank documentation. Let's look closely at the account description sections circled in red on this signature card. In opening new deposit accounts, your bank software often will have fields for you to input information pertaining to the ownership and type of deposit account. What we have done on the next few slides is to match up some of the typical bank account descriptions bank employees use in opening deposit accounts to specific FDIC ownership categories. We have done this simply to introduce the concept of how the information you collect at the time you open a deposit account will indicate which of the different FDIC deposit insurance ownership categories you may be attempting to use. So, starting at the top of this signature card, if you were to check the box identifying an account as an individual or single account, an estate account, or an individually owned DBA account, then all of these descriptions would be examples of deposit accounts that are insured under the FDIC's Category 1 single ownership accounts. Moving down the list to deposits that are jointly owned as either joint tenants with right of survivorship or tenants in common, these descriptions are examples of FDIC's Category 2 joint ownership accounts. For the purpose of FDIC deposit insurance coverage, Category 1 single accounts and Category 2 joint accounts cannot have any beneficiaries named. One of the most popular types of deposit accounts opened are payable on death or in trust for accounts, which are insurable under Category 3 revocable trust accounts. Continuing with our signature card, somewhat less common than revocable trusts are Category 4 deposits, which are accounts linked to an irrevocable trust. Category 7 specifically pertains to business organization deposits, including funds that are owned by a corporation, partnership, or an unincorporated association. Category 8 specifically pertains to accounts that are owned and meet the definition of a government entity. And lastly, Category 5 includes self-directed retirement deposits. As you can see in Category 5, this includes all types of individual retirement accounts, or IRAs. As we go through the remaining slides in this presentation, you will see how the information you collect about your depositor matches up to the different FDIC ownership categories. Finally, you will notice that we have included information about other common accounts, such as accounts opened by a broker. We have grouped these deposits as fiduciary accounts. Fiduciary accounts are not a separate ownership category. Instead, the ownership of the funds depends on the category in which the actual owner of the funds holds the deposits. As identified on this slide, there are 6 deposit insurance ownership categories which are available to individuals. We will discuss these 6 categories in detail. Our first category is Category 1, Single Ownership Accounts. The rule for coverage for single ownership accounts is simple. The only requirement in this category is that the deposit must be owned by a natural person and that no beneficiaries are named. Now, in addition to deposits that are owned by an individual person, there are some other common situations where deposited funds are specifically included and insured under Category 1 single ownership accounts. For example, a sole proprietorship deposit account, which is sometimes also called a DBA account or doing business as account, is insured under Category 1 single ownership accounts. While a sole proprietorship deposit is open based on a business activity conducted by the depositor, it is important to understand that a sole proprietorship is not covered under Category 7 business organization accounts. The reason is, with a sole proprietorship entity, the owner has not formally created either a corporation or partnership entity, which is required to be covered separately under Category 7 business organization accounts. In rare cases, a sole proprietorship or a DBA may be co-owned, for instance, by a husband and wife. If the owners have equal withdrawal rights from the account, then the account will likely be insured under Category 2 joint accounts, which we will discuss shortly. A common question the FDIC receives is, how does the FDIC insure an account set up for someone who has died? These accounts are often called either an estate account or a decedent's account. In this situation, the funds are considered legally still owned by the decedent, and a decedent's account is therefore insured under Category 1 single ownership accounts. Please note that the executor or fiduciary who may open this deposit account in the name of the decedent's estate is separately insured for any funds that the executor places in his or her personal accounts at the same bank. Deposits held under Category 1 single accounts are insured for up to $250,000. Therefore, all Category 1 single accounts held by the same depositor at the same bank are insured for up to a maximum of $250,000. One thing we're going to discuss throughout this presentation, and this is based on literally tens of thousands of questions the FDIC receives, are some common misunderstandings or misconceptions that we find both depositors and bank employees have in calculating deposit insurance coverage. Well, here's one of the biggest misconceptions. If you have a single deposit owner who designated the account as a payable in death and names beneficiaries on that account, the deposit will first be analyzed using the rules provided for under Category 3 revocable trust accounts. Another important fact to remember is that Category 1 single ownership accounts is the default category for individual depositors. This means, as you will see in the coming slides, if a depositor cannot meet the requirements of the other individual ownership categories, that is Category 2 through Category 6, the depositor can still be insured for up to $250,000 under Category 1 single ownership accounts. So at a minimum, any natural person who is the owner of deposit funds in an FDIC-insured bank is entitled to at least up to $250,000 in FDIC deposit insurance coverage. This rule applies to each and every FDIC-insured institution, regardless of the size or the location of the institution. Here is a simple example of Category 1 coverage. Jane Smith has 4 Category 1 single ownership accounts. Why are these accounts considered Category 1 single ownership deposits? Because Jane Smith is the sole owner of the funds, and she has not named any payable in death beneficiaries. A review of her account shows a savings deposit for $125,000, a CD for $100,000, a second CD account for $50,000, and a money market deposit account for $50,000. Her 4 accounts have a total balance of $325,000 under Category 1 single ownership accounts. Well, since only $250,000 can be insured, the difference, that is $75,000, is uninsured. Based on phone calls the FDIC receives, again, a common misconception that some depositors have is that by using different product types, such as CDs and savings accounts, the depositor can obtain separate deposit insurance coverage. This is incorrect. Remember, the type of deposit product does not make any difference in calculating deposit insurance coverage. We have now completed our discussion of Category 1 single ownership accounts. Let's move to our second ownership category of deposit insurance coverage available to individuals, which is joint ownership coverage. The requirements for joint ownership coverage are: first, each co-owner must be a natural person. The FDIC occasionally receives questions about setting up joint accounts with, say, a corporation or a trust. This arrangement would not qualify for joint account coverage. Second, each co-owner must sign a signature card, but there are exceptions. The common exception to this rule is when opening a certificate of deposit or when accounts are opened by a broker or agent. All co-owners are not required to sign a signature card. Electronic signatures are acceptable. Third, each co-owner must have the same or equal withdrawal rights to the deposit funds. This is extremely important. To establish a valid joint account, each individual on a joint account is considered an owner of the funds and must have the right to withdraw an equal share of the deposit funds. If it is determined that one person on a joint account is actually retaining control of the withdrawal of the deposit funds, then the FDIC will consider this person to be the true owner of the deposit funds and calculate the entire deposit as the true owner's Category 1 single ownership deposit. And the last issue to consider is that the FDIC will assume the ownership among all owners of a joint account is equal unless otherwise stated in the bank records. If the requirements for joint ownership account coverage are met, then the FDIC deposit insurance coverage is up to $250,000 for each owner of Category 2 joint account deposits. If a depositor establishes multiple joint accounts in a bank, the owner's specific ownership interest in all joint accounts are added together, and this combined ownership interest is insured for up to a maximum of $250,000. Here are 2 situations in which a deposit may not be insured as Category 2 joint accounts. First, remember that adding the name of a person on a joint account for convenience purposes may limit equal withdrawal rights and result in the account being insured as Category 1 single accounts. Second, if you have 2 or more owners of funds and they designate the accounts as payable on death and name beneficiaries, please remember the accounts will first be analyzed using the rules provided for under Category 3 revocable trust accounts. Next, we will discuss some common misconceptions about Category 2 joint accounts. Please note that the deposit insurance coverage for this category of ownership is not, and I repeat not, increased by doing the following. First, rearranging the names listed on the deposit account does not increase coverage. As an example, let's say we have 2 owners of a joint account, John and Mary. An account titled John and Mary is not insured any different than the account opened Mary and John. So switching the order of these 2 names in the title of the account is irrelevant. Second, another misconception that the FDIC is asked about is whether using different Social Security numbers on different accounts somehow increases coverage. It does not. Again, if John and Mary are co-owners of two joint accounts, and John's Social Security number is used on one of the joint accounts, and Mary's Social Security number is used on the other joint account, this does not double the amount of deposit insurance coverage. And the third misconception is that substituting conjunctions on different joint accounts will increase coverage. So, for example, if one account is titled John and Mary, and the second account is titled John or Mary, both of these accounts are added together in calculating deposit insurance coverage. Using different conjunctions on different accounts does not increase coverage. Here you see two joint ownership accounts opened at the same bank. Are both of these deposits fully insured? Well, our first account is owned by Jane Smith and Andrew Smith with an account balance of $400,000. Our second account has Jane Smith as the owner, with Harry Jones as the co-owner with her. The second account has a balance of $200,000. So, are all of the owners fully insured? In calculating the amount of deposit insurance coverage, we have to look at each owner's interest in all joint account deposits. Remember, there is a presumption that each person has an equal ownership share of the funds. So when looking at our example, we have account number 1, Jane Smith and Andrew Smith, as the co-owners of the account, with a total balance of $400,000. The individual ownership interest for each owner under account number 1 is 1/2 of $400,000, or $200,000 for Jane and $200,000 for Andrew. For account number 2, we see that the ownership interests are $100,000 for Jane and $100,000 for Harry. In looking at the column for Jane Smith in this example, you see that Jane Smith has a $200,000 ownership interest in the joint account category for account number 1 and a $100,000 ownership interest for account number 2. When we add Jane Smith's ownership interest together for both of these joint accounts, she has a total of $300,000 in the joint account category. Now, the most that any one person can have insured in all of their joint ownership deposits together is $250,000 per bank. And therefore, since Jane Smith has $300,000, she is uninsured for $50,000. This example shows that in calculating joint account coverage, a depositor's ownership interest in all joint account deposits must be added together in determining how much insurance coverage they can have under Category 2 joint accounts. The key point to remember from this example is that while Jane Smith did not have an ownership interest of more than $250,000 in any one joint account, her combined ownership interest in multiple joint accounts totaled $300,000, and that resulted in her having $50,000 of uninsured funds. On this slide, we will look at an example of the impact of the death of an account owner and the application of what we described on slide 12 as the 6-month rule. Let's assume John and Jane Smith had opened a joint account for $500,000 on January 1st, 2013. John dies on March 31st, 2013. What is the deposit insurance coverage for the account now that John has died? The answer is that for the 6 months following John's death, assuming that the account remains open and Jane does not retitle the account will continue to be insured for $500,000 as though John was still living. After the 6-month grace period, assuming the account has not been restructured, beginning October 1st, 2013, Jane would have $500,000 in Category 1 single accounts, with $250,000 insured and $250,000 that would now be uninsured. One of the most popular categories of deposit insurance coverage that is available to individuals is Category 3 revocable trust accounts. Before I discuss the rules for revocable trust deposits, let's start with defining these types of accounts. For the purpose of eligibility under Category 3 revocable trust accounts, the deposit must be a legitimate testamentary account. The term testamentary means that in establishing the account, it must be clear in the bank records that upon the death of the owner or owners of the deposited funds will then be transferred to one or more named beneficiaries linked to the account. For the purpose of FDIC deposit insurance, the term revocable means that while the owner or owners of the deposit account are alive, they are reserving the right to change who will be the beneficiary or beneficiaries of the funds. And they are also reserving the right to change or revoke the amount of money that each beneficiary will receive when the owner dies. For our discussion today, we will address the types of revocable trust described under the FDIC regulations. The FDIC recognizes two forms of revocable trust deposits: informal and formal revocable trusts. One of the most important questions we have to answer in determining deposit insurance coverage is, who are the beneficiaries of the trust? In other words, when the owner of the trust passes away, who has he or she designated to receive the trust assets? For deposit insurance purposes, a beneficiary must be an eligible beneficiary. The definition of an eligible beneficiary has been expanded to include any natural person or either a charity or nonprofit organization recognized as such by the IRS. This means that an owner can now name any living person as a beneficiary, even if they are not related. And in addition, any charities or nonprofit organizations named as beneficiaries that are valid organizations under IRS rules would also be considered eligible beneficiaries. Okay, we're going to discuss a question that we are repeatedly asked by bank employees. Does POD, or payable in death, or a similar term conveying testamentary intent, have to be in the account title of an informal trust? The answer is yes, but since October of 2009, banks can easily meet this requirement using their electronic record keeping. The revised rule provides that the FDIC will recognize a deposit as an informal revocable trust account, provided that the bank's electronic deposit account records designate the account as a payable in death account. For instance, this designation can be made using a code in the bank's electronic deposit account records. In addition to determining who is an eligible beneficiary and meeting the titling requirements, there are two other important questions to answer to calculate deposit insurance coverage for a revocable trust. Depositors and bankers must ask how many beneficiaries are identified by the owner and whether those beneficiaries are to receive equal or unequal allocations when the owner of the trust deposit dies. This is a two-part rule which will help us answer those questions. We will discuss the first part of the rule on this slide and the second part of the rule on the next slide. The first rule concerns revocable trust accounts with 5 or fewer beneficiaries. Assume we have an individual who wants to establish a Category 3 revocable trust deposit, naming 5 or fewer beneficiaries, and the total combined for all their trust deposits will be $1,250,000 or less. If the owner has named 5 or fewer beneficiaries, then the amount of deposit insurance coverage is equal to up to $250,000 times the number of beneficiaries named by the owner. But what if the owner has named 5 or fewer beneficiaries and the percentage or dollar allocations to multiple named beneficiaries is unequal? When 5 or fewer beneficiaries are named, we will ignore the unequal allocations. Under the rule, if you have named 5 or fewer beneficiaries, then regardless of the percentage or dollar allocation to the beneficiaries, you simply multiply the number of named beneficiaries times $250,000, and that is the amount of deposit insurance coverage that will be available. Now we will discuss the second part of the rule, which concerns trust deposits with 6 or more beneficiaries. Let's assume we have a depositor who has named 6 or more beneficiaries and wants to deposit more than $1,250,000. How do we calculate coverage? Well, if the owner has named 6 or more beneficiaries and the allocation is equal to each beneficiary, it's easy. As before, we are simply going to multiply $250,000 times the number of eligible beneficiaries named. So, for example, if there are 6 beneficiaries receiving equal percentages or allocations, then 6 times $250,000 results in up to $1,500,000. If there were 7 beneficiaries, 7 times $250,000 would be $1,750,000 in insured coverage. But what if the owner is attempting to insure more than $1,250,000, has named 6 or more beneficiaries under 1 or more revocable trust deposits, but has unequal percentages or dollar amounts allocated to the beneficiaries? This is a bit tricky. The reason is the rule for 6 or more beneficiaries named with unequal interest is different than the rule for 5 or fewer named beneficiaries with unequal interests. An owner who has identified 6 or more beneficiaries with unequal interest is insured for up to at least $1,250,000. If you have questions regarding a revocable trust account, naming 6 or more beneficiaries with unequal interests, please contact the FDIC toll-free at 1-877-275-3342 and ask to speak to a deposit insurance subject matter expert. For the next 2 slides, we want to discuss one of the most common misconceptions that we encounter, and it concerns the question of how to calculate coverage for revocable trust accounts. We will begin with the scenario of one owner of a payable in death account and one beneficiary. There is a misconception that deposit insurance coverage is calculated by adding the number of owners and the number of beneficiaries on a payable in death account. This is incorrect. To explore this issue, let us look at the first example where we will assume that John is opening a payable in death account, naming Lisa as the beneficiary of the deposit if he predeceases her. Assuming this is the only revocable trust account John has at this bank, what is the maximum insurable amount of deposit insurance coverage for this account? Herein applying our formula for 5 or fewer beneficiaries, we will simply multiply the total number of owners times the total number of beneficiaries times $250,000. In performing the calculation, one owner times one beneficiary times $250,000 would give us the result of $250,000 as the maximum insurable amount. This example illustrates perhaps the single biggest misunderstanding we hear again and again in calculating FDIC deposit insurance coverage for revocable trust deposits. The misunderstanding or confusion is that depositors want to allow $250,000 for John plus $250,000 for Lisa, or a total of $500,000. This is not correct. Please remember, unlike Category 2 joint accounts, where every individual listed on the account is an owner and entitled to up to $250,000 in deposit insurance coverage, the rules for revocable trust accounts are different. The key point is that coverage is determined by taking the number of owners times the number of unique eligible beneficiaries times $250,000. On this slide, we will explore a second misconception regarding deposit insurance coverage for a payable in death account with one owner and 2 beneficiaries. As you can see, there is 1 owner and 2 beneficiaries. This graphic illustrates one of the most common questions we receive from both bankers and depositors. If there is 1 owner and 2 beneficiaries on a payable in death account, shouldn't the coverage be $750,000? And the answer is no, that is incorrect. Remember, to determine deposit insurance coverage, we take the number of owners and multiply it times the number of beneficiaries and multiply that times $250,000. In this example, the calculation is 1 owner multiplied times 2 beneficiaries multiplied times $250,000, which results in $500,000 of deposit insurance coverage. Therefore, the deposit insurance coverage is $500,000, not $750,000. We have now concluded our brief discussion on revocable trust accounts. Next, we will discuss our 4th category available to individual depositors, irrevocable trust accounts. So, what does irrevocable mean? For the purpose of applying FDIC deposit insurance rules, irrevocable means that the grantor, in other words, the person who created the trust, does not possess the power to terminate or revoke the trust agreement. How is an irrevocable trust created? An irrevocable trust can be created through the death of a grantor of a living revocable trust or the actual execution or creation of an irrevocable trust agreement, or by statute or court order. An irrevocable trust deposit must be linked to a written trust agreement. You cannot create an irrevocable trust deposit by using POD or ITF in the account title. And let us emphasize that irrevocable trusts are far less common than revocable trusts. Most of the irrevocable trusts you will encounter will be the result of the fact that the owner or owners of a revocable trust account agreement have died. Unlike Category 3 revocable trust accounts, where the coverage can extend beyond the SMDIA, irrevocable trust coverage is usually limited to no more than $250,000. The rules for irrevocable trust deposits have significant differences from calculating deposit insurance coverage for revocable trusts. There are several important issues to consider when calculating deposit insurance coverage for irrevocable trusts. The first important issue is if the grantor of an irrevocable trust is alive and the grantor has retained an interest in the use of the trust assets during their lifetime, then to the extent there is a retained interest, these funds will be insured as Category 1 single ownership account deposits, not under Category 4 irrevocable trusts. The second issue to consider when calculating coverage for irrevocable trust deposits is contingent interests. To the extent funds are allocated to one or more contingent beneficiaries or beneficiaries with contingent interests, then these interests are added together and the combination of all contingent interests are insured for up to $250,000. Examples of situations that create contingent interest include: 1. Does the irrevocable trust agreement provide that one or more beneficiaries will not receive some or all of their designated bequests unless certain conditions are satisfied? 2. Does the irrevocable trust agreement provide that a trustee may invade the principal of the trust, with the result that the funds available for the other beneficiaries may be reduced or eliminated? An example of this would be a provision allowing a trustee to invade the trust for the support or medical needs of a surviving spouse or a beneficiary. 3. Does the irrevocable trust agreement provide that a trustee may exercise discretion in allocating assets among the beneficiaries, with the result that the future distribution to each beneficiary is impossible to predict? We have found that almost all irrevocable trusts that start as revocable trusts will have at least one of these contingencies. The third issue to consider when calculating coverage for irrevocable trusts is that if the beneficiary's interests are non-contingent, then there is pass-through coverage for each beneficiary up to $250,000 based on each beneficiary's specific allocation. We have now completed our discussion of trusts. Our fifth category of deposit insurance coverage for an individual was created by statute in 2006 and is described under the statute as certain retirement accounts. To begin, this category pertains to deposits that are typically owned by only one participant, with the funds representing a self-directed retirement account. Second, for eligibility under this category, the retirement plan must be self-directed unless a specific exception is described. That means the participant must direct the investment of their interest in the plan assets. If the investment decision is made by a plan administrator, then the deposit is still insured by the FDIC, but the amount of coverage is calculated using rules under Category 6, Employee Benefit Plan accounts. Third, the account must be titled in the name of the owner's retirement account. For example, individual retirement accounts, or IRAs, are the most common example of certain retirement accounts, and the account needs to be opened with IRA in the title. And finally, the coverage for Category 5, certain retirement accounts, is a maximum of up to $250,000. While IRAs are the most common form of self-directed retirement plans under this category, it is important to recognize that self-directed defined contribution plans are also included. A common misunderstanding about retirement plans insured under this category is that adding beneficiaries will increase coverage similar to deposits that are revocable trusts. This is incorrect. For deposits under this category, such as IRAs, the maximum deposit insurance coverage, even if beneficiaries are named, is up to $250,000 for the participant. Please note that all defined benefit plans are excluded from this category, as well as any defined contribution plan which is not self-directed. We will now discuss the last ownership category available to individuals. If your depositor has an employee benefit plan but does not meet the requirements of Category 5, certain retirement accounts, we will then look to Category 6, which is simply called the Employee Benefit Plan Account category. Under Category 6, the account title must clearly indicate the existence of an employee benefit plan, and the plan administrator must be prepared to produce copies of the plan documents. Assuming these requirements are met, the amount of deposit insurance coverage is up to $250,000 for each participant's non-contingent interest. The types of employee benefit plans covered under Category 6 include defined contribution plans that are not self-directed. And as mentioned previously, all defined benefit plans are insured under this category. As a reminder, Category 6 employee benefit plan accounts are fiduciary accounts that must meet the requirements for pass-through deposit insurance coverage to be insured in this category. We now move from the 6 categories for individuals to the one category that applies to business entities. Category 7, business organizations, includes corporations, including Subchapter S, LLCs, and professional corporations. Also included are legally created partnership entities and unincorporated associations. Coverage for business organizations is up to $250,000 per legal entity, provided that the entity is engaged in an independent activity. This means the business entity must have been formed for a business purpose and was not created for the sole reason of increasing FDIC deposit insurance coverage. Our 8th ownership category is titled Government Accounts, or sometimes they are referred to as public unit accounts. As with business entities, there is only one category that applies to government accounts. So, what is a government account? A government account is a deposit placed by an official custodian of a government entity, including federal, state, county, municipality, or a political subdivision. Who is considered an official custodian? An official custodian is an appointed or elected official who has plenary authority, including control or decision-making authority over funds in the account owned by the public unit. Coverage for this ownership category depends on the type of deposit and the location of the bank. For Category 8 government accounts, deposit insurance coverage is at least up to $250,000 per official custodian. Based on the regulation passed in 2008, the ninth category of deposit insurance coverage pertains to mortgage servicing deposits for principal and interest, or P&I payments. This category concerns accounts established by mortgagees or lenders and represents commingled P&I payments received from borrowers. The rule for Category 9 mortgage servicing accounts provides that commingled P&I payment or P&I accounts established by mortgagees or lenders are insured with coverage provided up to the SMDIA of $250,000 per borrower. This coverage is provided to mortgagees or lenders as a collective group and is based on the borrower's payment of principal and interest. Funds qualifying under this category are not added with any other deposits that the borrowers may have at the same bank. We have now completed our discussion on the fundamentals of deposit insurance coverage. Before describing some important deposit insurance resources in our last section, we want to take just a few minutes to review some of the main points that we have covered in our discussion today. Here in Slide 52 and Slide 53, we have identified 10 items to remember about deposit insurance coverage. Number 1, deposit insurance coverage is provided per depositor, per ownership category, per bank. Number 2, at the same bank, a depositor can be insured for more than the SMDIA if they own accounts in different ownership categories. Number 3, separate coverage is provided to depositors for separate account ownership categories. Number 4, all accounts owned by the same depositor in the same ownership category at the same bank are added together and insured up to the SMDIA. Number 5, deposit insurance coverage is up to the SMDIA and includes principal and accrued interest up through the date of the bank's failure. Remember, to be fully insured, the principal and accrued interest combined must not exceed the SMDIA. Number 6, deposits owned by one or more individuals that identify payable and death beneficiaries are insured as revocable trust accounts on a per beneficiary basis. Number 7, a payable and death account with one owner and one eligible beneficiary is insured for up to $250,000, not $500,000. Number 8, adding beneficiaries on an IRA does not increase the coverage because certain retirement accounts, such as IRAs, are insured for up to a maximum of $250,000. Number 9, to check your deposit insurance coverage, log on to the FDIC's EDI calculator at www.fdic.gov/EDIE. And finally, number 10, if you have any questions about deposit insurance coverage, call the FDIC at 1-877-275-3342. Part 4, Deposit Insurance Coverage Resources. In addition to today's presentation, the FDIC is offering 2 other seminars which cover a wide variety of topics. As you will see on the left side of this slide, in 2016, the FDIC will offer a seminar exclusively on revocable trust accounts, covering complex scenarios, including in-depth examples for revocable trust accounts with more than $1,250,000 in deposits and 6 or more beneficiaries receiving unequal interests. On the right hand of the slide, you will see that we are also offering a seminar covering advanced topics in deposit insurance coverage. This seminar will discuss government accounts, mortgage servicing accounts, bank mergers, and pass-through deposit insurance coverage, as well as other deposit insurance topics. The FDIC's website, located at www.fdic.gov, is an excellent resource for bankers, as well as any depositor or other interested party who is looking for information about FDIC deposit insurance coverage. The FDIC is constantly updating this website with current deposit insurance information whenever there is a statutory or regulatory change affecting deposit insurance coverage. Among the resources most accessed is the FDIC's Electronic Deposit Insurance Estimator, or EDI, which is an excellent tool to help calculate a depositor's insurance coverage based on either existing accounts in a bank or to check the amount of potential deposit insurance coverage that may be available based on a hypothetical scenario. In addition, the FDIC has written a number of deposit insurance guides available both online as well as hard copy. These include Your Insured Deposits, which is also available in a large print version. These brochures and other resources are available on the FDIC's Deposit Insurance Coverage webpage. If you are interested in ordering deposit insurance materials, including our brochures, videos, or FDIC signage, please go to the link provided on this slide and visit the FDIC's online product catalog. These materials are all available free of charge. The FDIC also offers computer-based training on deposit insurance for bankers. This user-friendly, self-paced training tool will assist bankers in understanding the basics of deposit insurance coverage. It is available on the FDIC's website, on DVD, and as a PDF. Finally, the most important resource is the FDIC's toll-free number. If you have any questions about deposit insurance coverage, please call the FDIC at 1-877-ASK-FDIC or 1-877-275-3342. This concludes our presentation. I want to thank you for participating.